Hi everyone, it's Joe Gordon, and today is Tuesday, August 25th, and it's noon, and it's our time for our weekly market update. As usual, we have to put our disclosure out here, which no one wants me to read, so I'm just going to go right by it. We're not giving investment advice or tax or any other kind of advice, just good data for you to derive and hopefully digest and make informed decisions. As always, you can follow us on YouTube. You can simply go to youtube.com and put Gordon Asset Management in the search area. You'll see all of the weekly commentaries come up, or you can sign up at wealthqb.com. So let's always this chart first, coronavirus news update. And again, the slide we talk about, we'll get to in a second, is the death rate, but COVID cases are climbing a lot. All you have to do is have a kid in college and you know about that, since they think they're immune to it. But anyway, so you see this here, the cases up from last week from 5.42 million to 5.71 million. Hospitalizations decreased though, and that's what's very, very interesting. A trend is actually going down. Maybe some of that's due to the partial shutdown of some states and areas of the economy shutting down again. And then you have the deaths did climb a little bit from 162,000 to 169,000. And then more importantly, the COVID-19 is on track to become the third leading cause of death after heart disease and cancer. But when you look at the death rate, it's way down over here, under 3% for the first time as a percentage of the number of cases, so less than 3%. Again, that's the data point that our doctor clients and other doctors around the country that are expert in this say we should focus on, is the death rate, but also the number of hospitalizations. The blue line here at the bottom has trended down significantly too. So those are the two most important things. School troubles, as I mentioned, UNC Chapel Hill made the headlines, probably not for something they wanted to make the headlines, as a lot of the students tested for coronavirus returned positive results, and so they shut down campus and said we're going to remote only. Interesting thing there, I saw news clips on some of the local TV stations showing people packing up and moving home, and I guess they're taking coronavirus with them to their family. That doesn't sound like a smart move. Anyway, you got Alabama having cases. I saw a comment, football coach Nick Saban was very upset at the immature behavior of the student population, and he said it. And then Notre Dame is going to transition online the next 2 weeks to stop the spread. So obviously, college students don't think they're taking it seriously in general, but there again, the death rate is less than like 0.02% or 0.2%. If they get it, they virtually it's basically a bad cold or a bad flu type episode. So let's go to the markets. You can see here internationally, EFI, Europe, Australia, Far East, developed markets, down 6.45 year to date, rose a tiny fraction last week. Emerging market equity rose 0.75% and now essentially is flat at minus 0.58% year to date, which is very interesting. The growth in emerging markets is all in e-commerce plays. One of our favorite ETFs is EMQQ. If you want to take a look at that, it's pretty interesting. Global aggregate bonds still up just under 6% year to date, again at zero bound interest rates, both in the European Union and the U.S. and most everywhere else. That's not a big deal. U.S. markets, the S&P went up just short of 2%, 1.66 last week, and now is up 6% year to date. NASDAQ gained 3.57%, led by Apple, ending up 33% year to date. It's hard to believe that the NASDAQ index is up 33% since January the 1st after the big dip in February, March. The Russell 2000 fell 1%, not a good indicator for a rally out of the recession, and is down 6% year to date, but that reversed a trend that was going positive. And there again is zero bound rates. The year to date, the Barclays Ag Intermediate Bond Index up 7%. So if you're in fixed income, you're happy. You have positive returns. If you're in the Russell 2000 or any part of that, you're probably not all that happy. If you're in NASDAQ, you're probably very happy. And if you're in the S&P, you're probably happy. overall because you're positive year to date. So now let's look at sectors, and then there seems to be a rotation going on. Now we look at quarterly returns. This is from July 1. You can still see energies a bomb, down 38% year to date. We'll see with all the hurricanes now. Marco, not a big deal, but Laura, apparently a big deal. Category 3 potentially hitting shore tomorrow, Tuesday, or Wednesday. They're evacuating. About 44% of the energy comes out of that Houston, New Orleans area corridor. But still, energy's been a terrible place to be. Some say it's a value trap. Materials, though, is a value sector, and it is up 10% this quarter. Something to keep an eye on, taking it positive year to date. Financials up 5%, but still down 20% year to date. And then you go over industrials, up 11%. So these are all typically value sectors, and they're all in a positive trend except for energy. But still, if you look at technology, up 13% quarter to date. Communication services, which is derivative of technology, up to almost 12%. That's still where the action is. There's no debate. Healthcare is trending up 6.7%. But overall, every sector is positive this quarter except energy, and that says a lot. So you can make money really any place, but obviously the masses have been focusing on tech and communication services, and even real estate's positive, which is good to see, and utilities too, for that matter, the traditional. We look at this every time, and I'm getting kind of worn out on this slide, but it does reinforce the same story, which is year to date. Growth trouncing value, large cap 25% growth to minus 11% value. That's huge. If you're in the middle, you're up 6.5. So you're probably not feeling all that bad, but not all that happy if you're overweighted value. The same is true in mid cap growth and small cap growth, although by much lesser degrees. A small cap value tends to have public companies, like think of very small regional banks and so forth, and that's just what you have there. That's overweight financials in that sector, small value. If you look at since the market low of 2009, growth is up almost double value, 757% to 369, up 50% more on mid caps, up a little over 50% on small caps. And since the peak, it's similar story in '07. So overall, if you look at current PE versus 20-year averages, you can see in large cap growth, which is where the mega techs are, trading at 31.5 times earnings versus a 20-year average of just under 19. So that's something to keep an eye on. A lot of these are trading at 1 to 2 standard deviations from where they normally trade. So anyway, now let's look at the gaps between market cap and equal weighted indexes. And the gap widened a little bit last week, probably because of Apple, if nothing else. But if you look at purple, the NASDAQ 100, of which the 5 mega caps are about 40–45%, up 33% year to date. If you look at the equal weighted NASDAQ, in other words, every stock has an equal weight, up 17.5% year to date. So basically a double if you're in the market cap over the equal weight, which tells you there's not much breadth. It's all a handful of stocks driving the returns. And the S&P is the same. The S&P 500, the blue dot, up 6. An equal weight of the S&P is down 4%. So, and one thing to note, the S&P, the 5 megatechs make up about 24 or so percent, call it 23 to 25%, depending on whose data you're looking at. So if you look at a recap of the markets, you can see here Apple rallied 7% last week, up 33% over the last month, 55% over the last 3 months, and started to close the gap on Amazon. So if you look at Amazon year to date, up 80%, Apple orange up 69% roughly, and then blue is Microsoft up 37%, pink is Facebook up 34%, although they hit an all-time high today. And then you have Alphabet or Google, two share classes, basically lagging up 20% year to date, and then the S&P, of course, up 6%. And you can see here the weight in the S&P over here of each respective megatech as a percentage, with Apple taking a lead, huge lead now. So moving on, what is going on elsewhere? Well, there's a big reconstitution of the major indexes coming up. First, the Dow announced their biggest shakeup since 2013 today or last night, and basically, because of Apple's 4-to-1 split that's happening August 31, they essentially Apple will become a much smaller much smaller piece of the price-weighted Dow index. So essentially, they'll become 1/4 the size of what they were. And so they didn't want, the Dow folks did not want to have a technology light index, so they added Salesforce. Similarly, they took out Pfizer and they're adding Amgen. Maybe that's more representative of future growth. And then Honeywell introduced, and out goes Exxon. Of course, Raytheon also out. What you generally saw today before the market opened was that all of the ones being added were up 3 to 4%. All the ones being thrown out are down 1 to 2%. And also Apple was trading down 2%, which is a shocker, I know, today, probably because of being removed as a significant overweight by 4 times in the Dow index, which is next Monday, I believe. Valuation measures, moving on. You can see here versus the tech bubble pre-burst in 99, we are pushing up towards that threshold. But again, if we take the 5 megatechs out, which is about 1/4 of the S&P index, then they're all trading north of 30 times earnings. Then the rest are at 16 to 17. I'm not that concerned about this data point. Inflation and gold. So inflation measured as by the S&P index has been benign at under 1%, just in spite of a near 20% expansion of money supply. So it's always a lagging indicator, but we got our eyes on it. Gold, though, is up 27% year to date, as the U.S. money supply with all the Fed liquidity has basically injected a floor underneath the stock market. Some would call it don't fight the Fed. And if they're quantitative easing and throwing money at the problem, stocks are going to continue to do good until they quit injecting liquidity. So we'll see. But one key data point here that really says a lot is the velocity of money. In spite of all the money being thrown at the problem, the velocity or turnover of that money in the economy is headed way down, way south. And that is not portend good news for economic growth. So another point is traditional inflation indicators. They really don't reflect the increase in the money supply. We know that, but it is what it is. And then let's look at unemployment. So continuing claims down, just under 15 million from 15 million and a half the prior week. Initial claims rose, though. I think that was a surprise, by 1.1 million from just under 963,000 the prior week. Unemployment, the U3 indicator at 10.2, down from the highest peak in May of 14.7. So again, I don't know if there's a trend there or not. I really think we're going to see a lot higher unemployment as a lot of these companies that got injected. I think the poster child of the airlines got their $25 billion each on the promise they wouldn't lay anybody off until October 1st. One data point on flying is I think TSA reported Saturday or Sunday over 800,000 people flew, which was the highest number since everything shut down in mid-March. But still, year over year, it's around 2.2 to 2.3 million of what the prior average number of people flying was. So here's something big that's coming this week, a speech on Thursday by Jerome Powell at the Fed. And basically, he's going to be talking about we're going to let inflation run above our target until we see it. And I guess what that means is basically rates are going to stay at zero until we basically solve the inflation issue and get things moving and employment is stabilized. I would think for sure they're going to do it until employment stabilized. For sure, I'm not sure they're ever going to get the inflation cat out of the barn, because they've been trying and they couldn't do it. And raising rates would do nothing but throw the economy in a recession. So it's no surprise consumer confidence tumbled to a pandemic low that last week. Again, think about it. If you have kids in school or college, and they're all being told it's all online, and they're all being told all these new rules and everything, and then there's virus outbreaks. It's no surprise to me. Also, people are probably not happy that the House and the Treasury are not negotiating. There's an impasse on getting more stimulus money to folks. So we'll see. We see on Tuesday the consumer confidence index dropped to a reading of 84.8, down from 91.7 in July. So that is a significant downdraft. On a positive note, housing. Man, things are going crazy. New home sales jumped 14% in June compared with June and July, and a remarkable 36% higher than the prior July 2019. That's incredible. And obviously, what's the fuel? I think it's two things. One, low interest rates, zero bound rates. People were refining like crazy too. And two, COVID-19. A lot of people decided we don't need to live in big, crampy buildings downtown and share common space. I think I'm going to get a house in the burbs. And also, many people realize that I don't need to live in a big city. I can live somewhere else and work remotely. But strongest gain since '06. And '06, you may remember, was when we were having the housing bubble stir up that Ben Bernanke famously said in '07, there's no housing crisis, it's all contained to subprime. Yeah, he got that one wrong. Anyway, so June's reading was also revised higher. But then when you look at low supply, strong demand, builders are raising prices. There's a lot of spec building going on around the Raleigh-Durham area in particular. People are building like crazy. Fuquay Arena is becoming a metropolis on its own, and now there's big retail and office being built there, which a lot of open-air restaurants. Some project of 150 million, I think, was announced 2 weeks ago. But one thing that's also happening is that prices may be going up, but parts are going up. It's hard to get lumber. And I heard a data point last week that if you aren't one of the biggest publicly traded builders, you probably are at the low end of the pecking order in getting lumber at a reasonable price to build. So to finish up for today with just 20 slides, what are we watching? Well, there's a lot of things. Obviously, we're watching the second wave of COVID-19. We're watching the school situation clearly because that impacts a lot of dual income families. It makes it extremely hard to work from home if you're also having to babysit your kids since they're not in school. Obviously, the election's coming up. Republicans started their campaign formally at the convention last night in Charlotte, and then you had the Democrats last week. So, third thing is the stimulus efforts. There's an impasse with House and Treasury. Who knows what's going to happen there? Somebody's going to cry uncle eventually. I believe Treasury is pretty steadfast that we're not going to throw a bunch of crap in there that isn't related to COVID-19. Inflation and then money supply expansion, we're watching that. There's no sign of inflation, but keep your eye on metals and miners. They're up 40%, the miners year to date, but they've trended off about 5% in the last 3 to 4 weeks. Maybe a good time to look there. Then we got the social unrest issue and National Guard deployment. The governor of Wisconsin deployed it, and I think it's at Kennesaw, where the fella was shot the other day, Sunday, with apparently had three of his kids in the back seat of the car. Sounds crazy. I don't know the whole story, but that's still a major issue. And then you've got the market breadth. I mean, when is the rest of the market going to start doing and pulling its own weight versus the 5 mega tax ruling today? That's something to continue to watch. At some point, they'll be selling. Probably not in Apple until after the formal split, August 31. And then you got the dollar. You know, it had been very, very strong. Then weekend, it was $1.18 per euro last week. I don't know what it is this week. Keep an eye on that. And then, like I mentioned in an earlier slide, there seems to be a little bit of sneaky value sector rotation going on with many of the value sectors that have been negative year to date this quarter starting to be positive, some up to 10%. So with that, we're going to end for today. And if you have any questions, feel free to email us at info@wealthqb. If you have the email of any of the folks here, including myself, joe.gordon@wealthqb, happy to take your call, happy to have a conversation about your portfolio and what's going on in general. Thanks and have a great Tuesday.